Hey guys, as you know, most of what I do is in the commercial space, primarily multifamily. We do some residential, certainly industrial, self-storage, office, etc. So I'm going to focus today on the loan delinquencies as they are right now in 2021. This isn't getting a lot of press, but there's certainly some things bubbling up that you're going to want to pay attention to as we move forward. And so don't forget to watch till the end, and of course hit like and subscribe and hit the notification bell, because I'm going to talk about some of the opportunities that we have at the very end, specifically as we start to see some of these big mortgages become delinquent and exactly how it's potentially going to affect you. Let's first talk about the different kinds of commercial, and I know there's probably more than this, but industrial, lodging, multifamily, office, and retail, they're the ones that get the most attention, and that's what we're going to primarily talk about. And so a lot of these aren't necessarily bank loans. What they call them are CMBS, or commercial mortgage-backed securities, and these are the delinquency rates right now. And as you guys can see, it's pretty crazy. So this was obviously in 2011, 2010 and 2011, which, I went through. And so obviously not as bad, but then we jumped up to here, which was, of course, late in 2020. And now we're here basically in March of 2021, as you can see them coming down. But essentially, as you can see, this bottom line here, this is industrial. Industrial's been great for lots of reasons, primarily as you just think of Amazon. Now, obviously, they're not the only one, but it's called last mile distribution. There's a big demand for shop at home, and so they've been taking down these big industrial centers and having all the products inside of there. So actually, the industrial sector has done very, very, very well. The next one is lodging. This has been the big problem, guys. So this one is lodging right here. No surprise that the hotel industry has just gotten annihilated. We're going to talk a little bit more about that. The yellow here, that's multifamily. As you can see, it dipped and now it's come back. And the red is office. And so that's right here. And office, ironically, has not done that badly yet. But as I'll talk to you about in a minute, you're going to start to see that as these leases start to renew, people are going to start to get smaller spaces, or they're not going to renew at all. And there actually is a fair amount of delinquents going on. And then the last one is retail, which is, of course, here. And that's kind of where the malls would be, those kinds of things. So obviously, the ones that are in the biggest trouble are lodging and retail, and we're going to go into a little bit more about that later. By the way, don't worry about taking notes on this stuff. You can just download the show notes below, just hit the link, and they'll come right to your inbox. You don't have to worry about all this, and we'll send it right to you. So what I wanted to do for you guys is I wanted to first go into what is a CMBS loan. I think this is important. So this is a commercial mortgage-backed security loan. And basically what they've done is, let's say these are the tenants and the customers right here, and they're actually in the commercial property. So, this is let's say an office building, this is a hotel, and maybe this is, a church or something like that, let's say. And these are the real estate investors here. And so these real estate investors are the borrowers, so they're borrowing this money, and the investors are the payers of the mortgage obligation. So this is where all the non-recourse loans are for the shopping malls and the senior housing and all that kind of stuff is kind of right here. And it all gets packaged into what's called the commercial mortgage-backed security. And essentially, they're taking your individual mortgage and they're packaging it up into a security and creating a bond. So this is exactly how it works. When I get a property, let's say I'm buying a multifamily property, it's very probable that the lender of that mortgage is going to then sell that off in some kind of a security later in some kind of a fixed product. Let's say I'm getting a loan for 5% and they get 4 or 5 more other loans at 5%. That means that the security, the bond, pays out 5%, and that's actually what pays out over here to the people that hold this paper. And so that's what a CMBS is. That's how the majority of the commercial lending works, is through these CMBS loans. Now, why that's important for you is because as these are not paid, then that trickles up to people that are the holders of those bonds. So here's what I want you to understand how the system works, guys. So these tenants, these customers, that could be a homeowner. That could be somebody that owns an office building. That could be somebody in a hotel or somebody in a self-storage or somebody in a multifamily. If those mortgages aren't paid, then that money does not trickle obviously up into the people that hold the paper. So let's say you are invested in a pension that holds this paper and that money's not paid to you. That means it literally doesn't make its way into your pension. So that's how that trickle works. So a lot of people are focused on the tenants and a lot of people are focused on the lenders. But at the end of the day, there's somebody holding that paper. There's somebody that lent that money. And so that's why this is so important. And these are big numbers, guys. These are big numbers. Okay, so now let's look at the delinquencies by property type. Now we already talked about accommodation, how high it is, and retail. So I think it's kind of important to understand which ones are the losers and which ones are the winners. The ones that are the winners are obviously industrial and multifamily, it's looking like, because as people default, let's say, in some of their housing, and they haven't completely yet, but some have, it's going to push more occupancy higher in the multifamily space, as an example. As cost of goods and cost of materials to build new housing goes up, then the affordability is going to go down and the buying is going to go down and it's going to create more and more demand. It's actually going to get worse. So let's just summarize this. The investors have already come up with 4 major property categories in terms of the pandemic effect. The counter-cyclical property types like industrial, data centers, single-family rentals, and self-storage received a boost from the pandemic. Property types like retail were undergoing systematic changes that were hastened by the pandemic. Properties like office may have been fundamentally changed due to COVID, we all know that. And properties like multifamily, grocery-anchored retail, or hotel, which will most likely pick up again when the virus is in the rearview mirror and the economy has recovered. So obviously every city, every county, every state is a little bit different. As you know, on the rent side, rents have declined in primarily these urban areas. The remote working is definitely going to impact a lot of different asset types because that is here to stay for sure. There's 2 big variables here. One is lenders have been willing to grant forbearance and push out loan maturities and also work with people on their default rates. In addition to that, the government's been throwing money at this. So it'll be interesting to see which ones actually end up to be winners and losers. So now let's focus on where the opportunities lie. So now let's talk about cap rate history and forecast. Now this is a great forecast by Moody's. And here we are right here, guys. So basically what they're saying is that these cap rates are going to go up in hotels and they're going to go up in retail. That's a good thing if you're a buyer, not a good thing if you're a seller, and you can kind of follow these cap rates. Now, of course, these are forecasts, but the one thing I want you to understand is if you guys can solve this problem, you can do very well and get very rich by buying some of these assets. Let me give you 2 extreme examples. So this hotel right here, as an example, is called the Lincoln Plaza Hotel, and it's in Monterey Park, California. This particular hotel was bought by the state of California to house homeless people. Now, obviously what they saw was they saw the hotel business not doing well right now, and they took the opportunity and they decided to buy it and fill it with a need right now because a lot of people are dealing with homelessness. The same thing's happening in Portland. So California and Oregon are right now actively looking to purchase hotels as emergency homeless shelters, as traditional housing or permanent affordable housing, even after the pandemic ends. Now let me give you another strategy for this exact same hotel. So this is the beauty of real estate. So if you dig a little deeper here, you're going to see that there's people that are already right now putting together funds, actual funds, to buy hotels to convert them to multifamily. So this same hotel, it's just a change of use. So it's clearly not doing so well as a hotel, and it doesn't look like it's going to be anytime soon. So the states are looking at them to put homeless shelters, and individual private guys, private firms are actually trying to buy the exact same hotels to convert them to multifamily, because we all believe that we're going to move more toward a renter nation as things get less and less and less affordable. And obviously you can convert these rooms rather cheaply when you have a building already built. Now you're just converting it and you're doing smaller spaces, have smaller rent. So just two completely different philosophies. Taking a look at these CMBS loans, where they're defaulting, and going in and trying to buy these assets, because these assets were built for millions of dollars and they're going to trade for 40, 50, even 30 cents on the dollar. So again, guys, solve the problem. That's all these guys are doing. So you need to start thinking about, as these mortgages default, as these things make their way through, where can you and your investor solve these kinds of problems, invest money wisely, and be socially responsible? It's a win-win for everyone. So instead of looking at these delinquency rates and going, oh my God, things are so bad, try to take a look at them from the other side of it, because these will make their way into good, affordable housing at some point. So thanks again for watching, and we'll see you in the next video.